She's a trailblazer and a name that commands respect in the world of investing. Devina Mehra, the woman who took India's investing game global, is now here with a book that promises to challenge everything you think you know about money. Money Myths and Mantras isn't just another investment guide. It's a masterclass in cutting through the noise, busting market myths, and arming yourself with the real rules of wealth creation. Why do even the smartest investors get it wrong? What are the biggest lies you've been told about investing? And most importantly, how do you build a winning portfolio in an unpredictable world? Devina Mehra lays it all out with hard data, deep insights, and a no-nonsense approach. Devina, thank you very much for joining us. Congratulations, the book is doing very well.
Yeah, thank you, Prashant. I mean, I had never expected it would become #1 on Amazon among all books. This was like totally beyond expectations.
It stays there. Yeah. What gave you the inspiration, first up? A quick, brief sort of outline of, time is hard to find and you wrote a book.
Yeah, I mean, it was vaguely in my head. Actually, it doesn't take me that much time to write, so time was not really, it was just deciding to do it because this entire book has been dictated on my phone. So I didn't even switch on the laptop. So once I know what to say, it doesn't take me time. But the real reason was that I always say that in our business, the input and output is money. Right. But for me, the real thrill is in the learning. Right. And this is one of the very few professions in the world where 30 years on, you can still say you're learning every day. There's never going to come a time when you know it all. Yeah, yeah. And because my parents were both professors, so it was kind of the teaching genes are there. So it seems that, once you understand something, you want to also explain it to people that this is the way. Have you looked at it this way? And that was really the journey for me to start writing articles, and then I thought of writing a book and putting it all together.
Yeah. And it's written simply. I mean, a beginner can read it, but also somebody who's been in the markets. I mean, I think one can go through.
Yes.
They'll also find the book useful. So that's something I found unique.
Yeah.
It's not very lay, it's not very complex.
Right.
It's a mix.
Yes. I mean, of course, the insights would be there even for people who have been in the markets a long time. Yeah. But I tried to make it as simple as possible and went against the general format. So therefore, there are subheadings, there are things in boxes, just as there used to be in our research reports. There are summaries, and wherever I have made videos on it, there's a QR code to take you to the video. And I've met people saying that, sometimes friends, kids saying, I don't have a background in finance, but I could understand it. So that's very heartening.
That's lovely. So let's talk about a few things from the book, right? You talk about markets forgetting history.
Right.
What are markets forgetting right now? I mean, let's make it current in the current situation.
Okay, so first of all, in a multiple choice, every viewer will get this right, that equity is a volatile asset class. So everyone knows in theory equity is a volatile asset class, but when you're living through the volatility, it seems like the end of the world. Correct. Always. So that is one thing which you forget history. I mean, you look at the last 18, 19 years, almost every year we've had a 10%, at least a double-digit correction, barring, I think, 3 or 4 years. And one of those exceptions years was 2023. So after 2 years, you have seen index correction, which is over 10%. So it's not the end of the world. It is not something which is unexpected. So those are the things you forget. You forget how volatile the small cap segment can be, where the falls in 2008-9 were nearly 80%. And in 18-19 was almost 2/3. So those are all the things which look very good when you look at the past. Yes, I would have bought here and sold there. But when you are living through it, you forget it. You forget the fact, and this is something I keep repeating, that only about 4,500 stocks trade in the market today. Many more have been listed. So many stocks just disappear into the blue yonder. So again, when there is euphoria like there was in 2024, when every riff-raff stock is running, every micro cap is running, you forget how many of these frenzies come and go, how many of IPO frenzies have come and gone, and what happens to the IPOs later. So there are many things of history that are forgotten.
And somehow you just want to believe that maybe this time is different, right?
Famous last words in markets.
Absolutely. So I'm going to, my questions are in no particular order, but I just wanted to, I thought I'll pick out some stuff that I found interesting.
Right.
You say that there is this myth that smart money always wins. right? Tell us some examples, one or two examples where the so-called smart money got it spectacularly wrong.
I mean, it depends on what you call smart money. So I'm saying, I mean, what the point I make is that don't try to replicate what a successful investor or fund manager did. Because for one, they may not be doing what you think they are doing. And I'm not giving this as a worst example, but simply because Warren Buffett is the most well-known of the investors. You think he buys and holds. But the data shows he sells 85% of what he buys within 2 years. The majority he sells within 6 months. So first of all, your general impression may not be supported by data.
Buffett, you think, well, the guy's been holding the same stuff for 50 years, right?
Yes, but that's not always the case. So, and also whether the performance itself is good. I mean, Warren Buffett has also underperformed the S&P for 20 long years. Of course, his underperformance is a little bit. Ray Dalio has been a spectacular underperformer, but people think like he's some kind of guru and you must follow him. All this apart, you are asking fundamentally the wrong question. That it is not that somebody who is rich and therefore classified as smart, what did they do? The question you should ask is that all the people who followed this strategy, what happened to them? Because, for example, you can have a very high-risk strategy where most people go out of business, but the few survivors multiply their money. So after 4 or 5 cycles of this, there will be a handful left who would have made out spectacularly, but that doesn't mean that that strategy was a good strategy. I mean, Rakesh Jhunjhunwala, somebody asked him that you made your money through trading, and now you say don't trade. He said, I might be a smoker, but I might still tell my kid not to smoke. Yeah. And many of, again, you know, in hindsight, all these, somebody gets classified as smart, but, you know, you don't know in the beginning. Even that person did not know in the beginning where they would make their money.
Yeah, yeah. And of course, I mean, past success does not guarantee future.
Of course. I mean, that is why, I mean, one of the people who many people like to follow is Peter Lynch. And I say that Peter Lynch, I give him credit not for his stock picking, but the fact that after a 14-year spectacular run, he knew that this is not replicable. And he retired in his mid-40s. You know, as early as that, because he knew that was a particular time in a particular market and that will not be replicated. So I give him a lot of credit for that.
Getting out right to the top.
Yes, exactly.
You know, you say investing is a loser's game,
right,
in the book. What do you mean by that?
So this is an old article of Charles Ellis, I think it's a 1970s article, that, and it's a mind-opening article that goes beyond investing, which is that everything in life is either a winner's game or a loser's game. So either you play, you know, superbly and aggressively to win in a winner's game, whereas in a loser's game, you play not to lose. So, for example, aviation, in J.R.D. Tata's time or Charles Lindbergh's time, it was an adventure sport. It was a winner's game. That famous flight, Karachi-London, you know, there some part didn't work. He wound a wire around something and made the plane fly. He missed airfields altogether and so on. But now there's only one way to fly the aircraft. Go by the checklist, make no mistakes. Yeah. And so also, I mean, tennis at a Grand Slam level is a winner's game. At your mohalla level, you should play not to lose.
Game of attrition.
Yes, exactly. Exactly. So same thing with investing. Maybe in our grandparents' time, it was a winner's game when information was not generally available. Getting annual reports was a problem. There were no Excel sheets. Now all the data is available. In fact, by law, a company cannot give differential information to anyone. So now you have this masses of data. You have the brightest people in the market. Now you have to play not to lose. Not to lose doesn't mean that you never book losses. In fact, you have to book losses by having stop loss, for example. By taking the small losses, you have to ensure that you don't take a huge and crippling hit on your capital. So you win if you don't lose. So.
But it's not, I mean, the idea is not to go completely defensive. It's not about buying defensive companies. I mean, that's the...
No, because those themes come and go. I always say in the markets, no theme lasts forever. No asset class, no country, no sector, no investing style for that matter.
You emphasize the need in the book for global diversification, right?
Yes.
And many will say, well, this is the fastest growing economy in the world.
Right.
So why do it?
Okay, two things. For one, I always give this statistic that when I started working, the dollar was 12 rupees. So there's been an 87% depreciation in the course of a single career. So when you're talking of your long-term financial goals, 10-year, 20-year, 30-year hence, there's no way you can forget this fact. So that's one. The other thing which you said about fastest growing economies, which were the fastest growing economies in the 90s? They were the Asian tigers. Right. India aspired to become an Asian tiger. And then came one year in 98, 99, when in 1 year, in dollar terms, all those Asian markets were down between 50% for Taiwan and 90% for Indonesia, and Thailand, South Korea, et cetera, all in between that 50 and 90. And that was a wake-up call for me. But that was the reason why I went global, why First Global became not just the first Indian, we were the first Asian members of the London Stock Exchange in 99. And so that was one of the reasons why. The other was that, I was bored of the same old companies. But coming back to this, that was a wake-up call because I had worked in Indonesia for a few months in my Citibank days. And I said, today, if I was in Indonesia, my net worth would have been wiped out by 90%. And this is the danger of having all your eggs in one basket. So
you call it single country, single currency?
Yes, CARS, single country, single currency, single asset risk. So let's say you are only in Indian equities. So that's like being in India in rupees, in equities. So that's putting all your eggs in one basket. That you should never do. And over a period of time, at least 30–40% of your investment should be global. And global doesn't mean the US. US is not the world. It has been doing very well for the last 10–12 years. It will not always do well. There have been periods when your US has underperformed hugely. 2003 to 7 is a good example. Emerging market index itself went up 3.5–4 times. India went up 6 times in that period. And US was an absolute laggard. So leadership changes, so it should be truly global. And because it's a cause for me, I mean, we have a product that is truly global that starts at $10,000, only 8.5 lakh rupees. Because I think Indians do not think global enough. And part of the reason is that we did not have this avenue when we were growing up.
Right.
There was no, you could not send capital abroad till a few years ago.
I mean, it's allowed now to up to a limit, etc. And mutual funds also.
But I mean, the limit is very generous.
Right.
I mean, it is 250,000 per person per year. That is, I mean, a family of 4 can send out $1 million every year. That's like way above the limit anyone requires other than the family offices.
Devina, stay with us. I'm going to take a very quick commercial break here. Let's take that break. Stay with us. And we are in conversation with Devina Mehra. We're discussing the very interesting book, Money, Myths and Mantras. Stay with us.